Hello, and welcome to the earnings release call at TDC and DKT. My name is Henrik Hjortøj Nielsen. I'm the Head of Treasury and Investor Relations. Thank you for joining the conference. As a new initiative, we will do the earnings release call via Microsoft Teams. I'll be moderating the event today. So first of all, we kindly ask you to mute your microphones during the presentation. If you want to ask questions during the Q&A, please write your name and organization in the chat and we'll return to you. We will do the Q&A after the presentation. I have with me today Group CFO Lasse Pilgaard. Lasse will present the highlights of the quarter and then continue to take you through the performance for the group, TDC NET, Nuuday and DKT Holdings. After that, we will open up for the Q&A session. And now over to CFO Lasse Pilgaard.
Thanks a lot, Henrik. So good afternoon and welcome to the TDC and DKT Holdings Q2 2020 conference call. Thanks a lot for attending the conference today. So let's turn to page 2, where I'll present the highlights from the TDC Group in Q2. In Q2, we saw a year-over-year decline in revenue of 7.7% and a decline in gross profit of 8.3%. This was driven by extraordinary high loss of customers in especially Q4 and Q1, causing the run rate pressure on this quarter's top line. Despite this, EBITDA declined 3.7% in Q2 as we managed to significantly improve our operating expenses with 13.6%. Cost reductions were realized through efficiency measures across TDC Group, as well as lower costs related to the separation of TDC. This is something we also expected, but now also start seeing being realized. Nuuday and TDC net operating expenses as a result decreased with respectively 11 and 9.9% in Q2 versus same period last year. The effects of COVID-19 on TDC Group's financial performance in Q2 were mainly related to the reduced roaming profits in Nuuday and the productivity slowdown due to TDC NET technicians remaining at home. Based on our business development, the continued traction in cost savings and negative effects from COVID-19, both in the short term and given the uncertainty in the longer term, we expect to reach a flat to slight decline in EBITDA for the full year. In Q2, we also saw good progress on our infrastructure investments across Denmark. The fiber rollout has run in full speed and again in this quarter delivered more than 25,000 fiber homes passed. Also, the mobile swap saw good progress with more than 50% of our mobile sites that has now been swapped with the latest 5G equipment. And we also successfully managed to test the equipment in Helsingør together with TV2, which is the national broadcaster. TDC NET has also partnered up with Grundfos to use 5G to automate and streamline their production, a partnership that we're very excited about, as it will strongly demonstrate the 5G opportunities that we think lie ahead for the Danish business and society as a whole. On the 7th of July 2020, we announced the launch of UTV, which will happen later this year. UTV is a new TV and streaming service that will gather all the popular content in one app, allowing customers to mix their preferred TV channels and streaming services without having a traditional TV package. The Danes are some of the most active streaming customers in the world. Therefore, we believe that UTV will fit perfectly in this segment as it really brings together a complete digital and flexible TV and streaming service that only requires an internet connection and the fact that you download the app in the App Store. So let's turn to page 3, where I'll give you the TDC Group financial highlights. In Q2, reported revenues decreased by 7.7% as you continue to see commercial headwind, though partly compensated from strong performance from the other Nuuday brands. The revenue decrease was hence mainly driven by a decline in TV, some decline in internet and network, and a minor decline in mobility service revenue. On operating expenses, we saw a decrease of 13.6% in Q2, or equal to 139 million Danish kroner. The improved operating expenses were fueled by strong cost-saving initiatives in Nuuday, following the enterprise agile transformation, as well as a more broad focus across the TDC NET and group functions to reduce operating expenses. EBITDA as a result decreased by 3.7% in Q2. As mentioned earlier, of course, driven by the top line pressure that we saw and compensated through the opex savings. This also shows that despite the recent commercial headwind and current COVID-19 impact that has impacted the market, TDC's focus on efficiency supports the stabilization of EBITDA. Capex for the period increased 16.1% to 1.3 billion Danish kroner, primarily driven by fiber. This level is very comparable to what we did in Q1, i.e. the COVID-19 situation has not hindered our investment strategy and intensity in Q2. I'll return to this on the next slide. So on page 4, we check in on opex and capex developments. In Q2, reported operating expenses, as mentioned earlier, decreased by 13.6%. We talked about the continued cost-saving programs in Nuuday, TDC NET, and Headquarter, and to some extent it was also driven by the reduced subscriber acquisition cost and general optimization across the organization. Of course, we also took initiatives when COVID-19 hit to reduce our overall burn rate. The improvement in operating expenses across the organization is also an indicator that the separation of TDC NET is progressing according to plan and that the costs related to the separation of TDC are ramping down. The quarter's last decrease is also driven by a large one-off cost last year, but even after correcting for that, we continue to deliver large single-digit opex improvements again this quarter. In Q2, capital expenditure totaled 1.3 billion Danish kroner, an increase of 16.1% compared with the same period last year, which was in line with our expectations. 2020 is the year where we upgrade our network to 5G and continue to execute on our fiber rollout strategy, why we also, of course, see very high capex levels this year. We are still working hard at investing in splitting and renewing our critical IT landscape so that Nuuday and TDC NET have the best possible foundation as independent market players. So even though a lot of the opex related to the separation is ramping down, there are still some capex activities related to IT that will continue for some quarters to come. On page 7, we check in on the financials of TDC NET. Revenue in TDC NET declined by 4.9% in Q2 year-over-year. This was mainly driven by declines in TV due to the phase-out of the legacy service provider TV business and a continued decline in the landline voice customer base, as well as declining revenues from coax upgrades and services from third-party antenna associations. The latter being a smaller and smaller focus area for TDC NET, given the focus on fiber. However, on mobility service revenue, we saw an increase due to higher traffic. On internet and network, revenue was flat as ARPU increases from an improved customer mix with more fiber customers were offset by customer decline mainly from DSL customers. The revenue decline combined with a slightly higher gross profit margin led to a gross profit decline of 4% in total. The operating expenses in TDC NET declined by 9.9% in Q2, driven by lower personal expenses, despite we actually saw an increase in FTEs, which is of course due to the increased capitalized projects that they're working on. Due to the efficiency improvement in operations and increased investments in fiber and 5G, as more personal expenses are capitalized, as I mentioned, and lower costs related to the separation of TDC, we were able to realize these fairly high operating expense improvements. The decrease in revenue was mostly offset by positive developments in our operating expenses, and as a result, EBITDA only declined by 0.6% in TDC NET. On capital expenditure, TDC NET continued to invest in fiber rollouts. As mentioned, we reached 25,000 homes passed in the quarter, and we swapped a little bit more than 50% of the 5G sites to 5G. For the year, we are now at 60,000 homes passed, which is a big milestone for us to achieve, and also more than we achieved at the same time last year, if you compare those 2 years together in terms of fiber rollout. Just last point on fiber and on capex and TDC NET, we also saw investments related to customer installation increased due to high gross adds on coax and fiber. All in all, we saw capex increasing in TDC NET of 19% year-over-year. COVID-19 only had minor effects on capex, i.e. decreased productivity and postponement of new network implementation to later this year. However, the fiber rollout and mobile swap has continued as expected during the last months. We did have a short slowdown in, you could say, when the lockdown was at its highest in Denmark, but we managed to catch up already most of that. For the rest of 2020, the year-over-year increase in capex is expected to be high in Q3 due to the 5G swap, but more or less flat in Q4. On page 9, we'll check in on the financials of Nuuday. The revenue in Nuuday declined by 6.4% in Q2 year-over-year. This was driven by revenue declines on the back of lower customer bases compared to the same period last year, and of course, driven by the extraordinary high churn numbers that we had in Q4 and Q1. The decrease in customer bases was partly offset by higher ARPUs in both consumer mobile and internet and network. This was primarily driven by price increases and speed upgrades, respectively. The revenue declines can, to a large extent, as I mentioned, be contributed to the extraordinary high losses, but of course we're also seeing, as part of COVID-19, some impact from roaming revenues. However, we actually did see in Q2 a significant impact if you compare Q2 and Q1, the customer base developments. And if you look into Q2, we also saw a month-by-month improvement in those numbers. The revenue decline was, of course, the main reason for the 12.5% setback in gross profits that we saw in Nuuday for the quarter. The operating expenses in Nuuday performed better than last year, so we here see an improvement of 11% year-over-year in Q2. As already mentioned, Nuuday took the first step of becoming a lean digital service provider here in May through the enterprise agile implementation. The organization has been slimmed, and therefore a reduction in personnel expenses were the main driver of the improved performance on operating expenses. We also saw, further to support this, a very positive development in reductions in acquisition cost and lower marketing expenses. Overall, these events on top line and bottom line led to an EBITDA decline of 15.3% in Q2 year-over-year, which is a 83 million Danish kroner improvement since Q1 last year. A development that we are not, of course, satisfied with, and hence we are focusing to stabilize that going forward. On capital expenditure, we realized a saving of 2.2% year-over-year in Q2. This was driven by lower costs related to customer installations and partly offset by higher IT investments. Staying on Nuuday, we'll go to page 10, where we'll go through the products and performance in Q2. In internet and network, gross profit decreased by 7.8% in consumer and 8.8% in business. Not surprisingly, the main driver was declining customer bases in both segments compared to the same period last year. The ARPU development in Q4 19 and Q1 20 plays a large role here, as it does for all of the products, as customer losses improved towards the end of Q2. The negative development was partly offset by higher ARPU in the consumer segment due to price increases. In mobility services, we saw a gross profit decrease of 2.3% year-over-year in consumer and 8% in business year to date. The decreases were driven by declining customer base and lower business ARPU. COVID-19 also impacts roaming negatively, and this too has a negative effect on gross profit. This partly offsets the negative gross profit growth that we saw in consumer through increasing ARPU. On a positive note, and despite losing customers in our consumer division, we managed to increase our mobile market share revenue share markedly in Q2, which is also a reflection that the entire mobile market has had a very difficult Q2 in Denmark. Looking at TV, in our TV business, gross profit declined by 19.5% year-over-year in Q2, which is driven by the decline in customer bases primarily. The impact from the customer base loss in Q4 and Q1 carries a significant run rate effect in the Q2 numbers, as the RGU loss development improved throughout Q2. Content costs in Q2 were lower compared to the same period last year. However, revenue declines were greater than the cost savings, resulting in a gross profit margin decline year-over-year. The inclusion of streaming services in our TV packages, investments in content, and our own TV channel C were the main drivers of the margin decline. These investments continue to serve our vision of delivering first-class entertainment and flexibility for our customers. Even though the largest decline in customer base relate to previous quarters, the current TV development is not satisfactory, and of course, the initiatives related to launch of UTV is one of our main levers to change this trend in the short term. Just lastly on landline, in landline voice gross profit declined by 14.3% year-over-year in our consumer division and 13.3% in business. The main driver is declining customer bases in both segments. This follows a fairly constant trend that we've been seeing for landline voice. I'll turn to page 12, where you can see the DKT Holdings financial highlights. As you know, all operating activities relate to TDC's activities. Accordingly, EBITDA and capex largely reflect TDC's corresponding figures, i.e. is very much a mirror of the TDC AS accounts. The loss for the period was negatively impacted by the interest expenses on DKT's debt. Turning to page 13, you'll find a leverage table for the TDC Group and DKT Holdings respectively. TDC's net interest-bearing debt was 20.8 billion Danish kroner and 31.4 billion Danish kroner at DKT Holdings. Liabilities due to mobile spectrum and the effect from IFRS 16 on leases were 6.7 billion Danish kroner. Leverage at TDC AS, excluding the effect from IFRS 16, was stable at 3.7x EBITDA from March 2020 to June 2020, and the leverage at DKT Finance Group was also fairly steady at 5.5 times EBITDA. So summing up, financial results for Q2 2020 was impacted by the high net loss of customers in Q4 and Q1. However, we did see improvements in Q2 versus Q1 and also saw improvements throughout Q2, which of course makes us optimistic on the coming quarters. In the quarter, we saw a continued traction in the improvement in operating expenses, and based on the development of our business, we expect to reach a flat to slight decline in the EBITDA development for the full year. And now over to Henrik, who will moderate the Q&A session from here.
Thank you very much, Lasse. We would like to